Well, that happened even faster than we had anticipated. We're talking about inflation today. It's Wednesday, February the 12th. Be sure to subscribe, like, or hit the alarm bell for this podcast. And you can also visit our webpage at marketswithmegan.fm. Let's dig into that inflation data that we got today and why the markets are off today. First of all, the inflation data for the month of January came in a bit hotter than expected. Core inflation, which is what's most important to the Federal Reserve, excludes both food and energy. And energy prices contributed to an increase in the headline reading. But when you strip those things out and try and take out the volatile items, it rose 0.4% in January. Doesn't sound like a lot, but that's actually a pretty big move for inflation. On a year-over-year basis, inflation was supposed to come in at the core level at 3.1%. It came in actually at 3.3%. So it moved higher over the prior month and actually was higher than anticipated. So this was not something that the markets wanted to see, nor the Federal Reserve. But let's talk about where this is concentrated. First of all, food is a problem. We know that. I think most people have heard or experienced the increase that we've seen in egg prices, which were up 15% just in January alone. So it's not just food, it's also shelter costs. These things continue to rise, and this is a big portion of this index on how it's calculated. So shelter costs are rising. We also saw things like used cars and airfare rising for the month. This all kind of overshadowed the declines we saw in some things like apparel. But one of the other areas that we've looked at on the service side of things that I think hits home for so many Americans, and that's when you look at things like motor vehicle insurance. Motor vehicle insurance continues to be a problem for consumers. It's up more than a double-digit pace on an annual basis and rose again in January. So this is a problem. These are things the Fed can't control. We think what this is doing with this read today, again, it's 1 month. We often say, let's see this further of a trend. We have been talking, though, about how there's underlying components of inflation that continue to show us some warning signs, and we're seeing it now in these readings. There still are a couple more inflation reports we'll get that we can come back to you with on those reports as well. But for the March meeting, the Fed won't be cutting interest rates. We think that that's off the table. We actually think that the first interest rate cut, if they can do it, if this inflation turns around, won't be till the second half of the year at the earliest. So this is obviously why the markets are looking at this. They're pricing out some of the Fed rate cuts, higher for longer, especially long-term treasuries. We've seen those yields move higher. Unfortunately, that's not going to do much good for the housing market as well. That's all we have today. We'll be back with some more of the inflation data and some more economic indicators that are impacting the markets. Thank you.